Yo, what's up, guys? I believe I just found the ultimate dividend stock of all time. Where if you were not impressed with this company and their financials, you have permission to hit the dislike button. This company actually can afford to 5x their dividend right now. And right now, they pay a 2% dividend yield. They could 5x it to a 10% dividend yield, no problem. And the company I'm talking about is ticker symbol EG, Everest Group. They're actually an insurance stock. They're well above the 2019 level price, and I am shocked they're not up more. The market cap on this company is $17 billion, so they're not a small company, $17 billion. But check out the dividend. This is the most impressive part I really want you guys to pay attention to. So right now their dividend is $2 per share. They just rose it from $1.75. But let's see how much their dividend costs them and see how much they make. So their dividend costs $2 a quarter, and in net income per share, so EPS, they made $16, which just in the most recent quarter pays for the whole year of dividends times two, times three. So that's why I'm saying this company can easily afford to raise their dividend to like $8 per share. And that's looking at the net income per share. I like looking at the free cash flow per share, which I love the per share metric because it includes stock-based compensation and any stock issuance. But check this out. It's $25 per share. They've never not been able to afford this $2 dividend. It's absolutely crazy. Like, imagine they paid $15 in dividends per quarter. Like, they could afford that with their free cash flow. And what's the multiple, the net income multiple on this company? This company is trading at 5.8 times net income. I kid you not. Look at the net income. It was $733 million, up 100% year over year. And since they're an insurance company, I like to look at these metrics right here. The total premiums earned, which is up 21%, and you can kind of see the long-term growth on this company. It's phenomenal. But also the net investment income. This is what they're doing with the funds. And right now, you want to be an insurance company because you can just put that money in the T-bills and the money market funds and get a risk-free 5.5% yield. And that's what this company's doing. Their net investment income's up 75% year over year. That's absolutely crazy. But more importantly, remember they made $800 million of net income in just the most recent quarter? Their dividend cost them $76 million a quarter. So remember, $76 million a quarter. They made in just one quarter $733 million. And let's look at free cash flow, $1 billion. Like, is there something I'm not understanding here? And let's check out the diluted weighted average shares. So this is the one thing. You have been diluted 10.85%, but that's actually because they had a merger with the company, an all-stock merger for $1.45 billion. But ever since that merger, they've never issued any shares since then. Matter of fact, they bought back $56 million of shares in the most recent quarter. And I'm not mad at them for not buying back stock because, well, the stock is at all-time highs. So if this company ever does have a substantial dip, this company is ready to buy the dip with the free cash flow that they have. They're not obligated. They don't have a huge payout ratio. If we go over to Moomoo, this says their payout ratio is 11.3%. It says that's the trailing 12 months dividend. So they just rose the dividend. That's why it says 1.76%. But this company has cash on hand of $1.5 billion. Let's see their total debt. Total debt of $3.39 billion. This company is doing so good. Look at the retained earnings. These are some of my favorite accounting metrics. It's up 21% year over year. But this is where it starts to get a little crazy. This company has a free cash flow yield of 27%, which means they make 27% of their entire market cap just in free cash flow just in 1 year, which is absolutely crazy. Let's see what the analysts are forecasting about this stock. So we got a pretty good amount of analysts over here. They're saying the low is 375, which is a 4% decline from here. That may be a potential buying opportunity if it gets to 375, but most of the analysts have an average price target of $428 and $460, which is pretty crazy. So the average analyst is pretty bullish on this. We got Wells Fargo, Citigroup, and these are, well, they're kind of recent, April. So like I said, it's not the most popular stock because look at the annual EPS growth. I mean, this is just crazy. Oh, this is the estimates. This is the EPS forecast. They're expected to make $80 of EPS. So do a 20% payout ratio of 80. Isn't that 20 or no, it's like 15. Okay, so 20% of 80 is 16. That's what I thought. I'm like, it's not 15 It's not 20, but it's 16. I don't know why I'm going into all that. But let's check out some other stats over here. A return on invested capital of 17.83%. I mean, that's inflation beating. Free cash flow margin of 30%. These insurance companies are just $100 in free cash flow per share. Oh my goodness. So remember how their dividend cost them $79 million a quarter? Well, in free cash flow, they made $4.6 billion. Yeah, you gotta let me know what your thoughts on this company is in the comments. I mean, this company is just I don't believe it almost. Is there something I'm not getting here? I'm trying to find the bad news. But they're just such a profitable company. I mean, $67 in EPS. But thanks so much for watching. If you want to subscribe, I do stock portfolio updates on the time, more in-depth dividend analysis. I love doing the financial analysis just like I did on here. I do the most important numbers. But yeah, thank you all so much for watching. Don't forget to hit the like button, and I'll see y'all next time.